This week, not so much a fund focus, but we're focusing on returns generated by private equity in South Africa. And Cobie, you're going to set the scene for us.
Thanks, Eleni. As Emile said a little bit earlier on, there's a lot more interest in private equity, and therefore we've got kind of broad-based consulting groups trying to follow what's happening in the private equity space. And I'd like to share some results with you, specifically put together by Riskera. This just kind of, let me just give you the kind of synopsis around kind of some of the funds they looked at. 25 funds in South Africa, 14 different managers, all in South Africa. The fund sizes there are from small, 100 million, all the way up to 8 billion. So it's got kind of a nice mix of different asset sizes. Various vintages. Vintages basically refer specifically to different tranches that happen through different times, and it'll come clear to you a little bit later on. Internal rate of return is utilized as a performance measure, normal for the private equity industry, and it covers 10 years of data. Let's just look at some of those data points. Let's just focus here specifically on 10 years. FINDI, which is that kind of light blue block that you see over there, indicates the financials and industrial sector listed on the JSE. You see the return there at 14.4. The all-share index at 15.7. The shareholder weighted index doesn't quite go back that long, so you're not seeing a data bar for that. And then you see the internal rate of return for private equity up at 20.1%. So certainly fantastic type of returns. Let's just look at the next chart there, which is pooled internal rate of return, and this is now by vintage year, and you can see pre-2000. Those are obviously the ones that have been around for the longest. You see the type of return there. Again, returns here all net of fees. The fees have been taken out of the equation. Obviously, the private equity teams have to make some money out of this along the way. And then the last one, pooled internal rate of return by time period, and you can get there again. See over the 10-year period there, 20.1. Relative to equities, 15% over the long term, which is over the last decade specifically.
Emile, maybe you could give us an indication of how things could actually go wrong, because it sounds like a very risky investment. Returns, as Cobie has actually just said, that could match to what we see on the equity front.
Yeah, well, a good example, Eleni, you would see different returns by vintage year, for example. If you were an investor and you only invested in one private equity fund, and you invested, for example, in a 2005 or 6 vintage, meaning they started investing in 2005-6, you could very, very well find that fund would have invested throughout the bull market into high rising prices. And by the time they actually get into a position where they really have to start selling their investments, they're in the current environment. So very important is for investors in private equity funds to actually get diversification across different kinds of funds, which would essentially
What would your benchmark then be, Emile?
Our benchmark, generally, how private equity funds are structured is that they promise to investors a hurdle rate, which is a absolute minimum rate. That's sort of comparable to a bond type rate, etc. So we promise that we deliver that to them. Over and above that rate is really where we also start then sharing in incentive fees. And then what we have, for example, in our fund is as a target IRR for investors, 15%, but in dollar terms. And even though that's what we then aim at giving on a fund basis, we're essentially targeting 20% type IRRs.
Cobie, do you want exposure to the private equity space? Do you have exposure?
Well, Eleni, I think the important thing for investors, and I mean, and again, you asked me that question, so I'm kind of indirectly saying that this is what investors should do. Kind of looking at private equity. Yes, we are definitely interested in private equity. Let me put it to you this way. Philosophically, you have to buy in what different managers are doing. There's specific processes that they put into place, so you've got to understand those. You then have to understand how those potentially can translate into returns and what those returns have to be. And then when you're going to do asset allocation, you have to make sure that the asset allocation that you do, that the parameters that you utilize for that asset allocation is kind of always on the conservative side. So if you're modeling that normal equity should give you about 15% per annum, well then 20 is probably pretty reasonable for private equity. If you only expect out of normal equities over the next decade because of a very depressed economic cycle, 12% out of normal equities. Don't expect private equity to do 20 or 25%. Expect it to do less. So it's kind of about asset allocation, about understanding what managers are doing.
So it's not uncorrelated to any financial crises that could occur, really depending on what kind of private equity you actually invest in.
Yeah, exactly.
Right?
It is still exposed to the economic market, but less volatile and less correlated. Also, if your average returns are really 20, it really, as Cobie says, it depends the fund manager that you select. Your top quartile type fund managers in that kind of scenario delivers 30-40% type IRRs, which are phenomenal, and the guys with a good track record continue delivering those kind of returns.
Why private equity over hedge funds?
I think there's space for both of them, essentially, in a market. Again, I think hedge funds, as we know, is absolute return type funds, so they actually give you some protection in down markets. Private equity, we believe, gives enhanced returns during all cycles. So during bad cycles and good cycles, but it is more correlated to the markets than hedge funds would be.
Volatility mechanism is completely different in hedge funds. Hedge funds, you're making use of normal asset classes. So you've got sentiment playing a far bigger role there in the short term than it will in the private equity space. Private equity space, if the price is 100, the price is 100. The only thing that will change that is an economic cycle, and then probably quite slowly.
Gentlemen, we have to wrap it up there. Thank you very much. Cobie Legrange, pleasure always. And of course, Emile du Toit. Great to have you on the program.